Good afternoon all, how are you doing? Please let me know if you can hear my voice and if you can see my screen. Friday the 30th of July, just coming up to 1/4 the hour. Finally we've reached the end of the week, and the week which really has been built all about today's GDP figures. Hopefully the climax of the week, and that will finally give us some direction on what otherwise has been a very sideways moving market. Just to emphasize this point of a lack of direction in the long term in this market, I've now got a long-term continuation chart of the E-mini S&P here, going back to really the end of May. And I'd like you to look at the pattern here. I mean, this is, May, June, July. Over that 3-month period, we haven't really gained any consistent direction in either way. Now, this is a very wide range. Don't get me wrong, this is a huge range. And at the moment we're kind of oscillating around the 1100 spot figure, but it, I think, sums up the trading conditions we've seen over the last couple of days, with moves being very quickly reversed, direction being very hard to find. So have an eye at your longer term chart, have a look at that, and just sort of keep that in the back of your mind when you're looking for those breakout trades into what exactly the market has been doing over the last couple of months. Let's have a look at the shorter term. I've got an E-mini 15-minute chart up here. We can have a look at yesterday. So yesterday there was a couple of things really that happened. The first was the Exxon results. I'll come on to those later when I look at oil. But from the point of view of the E-mini, we had initial jobless claims data, and this was generally positive. It was mixed in the fact that new claims was only slightly better figure, and continuing claims was slightly worse. But a lot of traders were looking at the 4-week moving average. Okay, and overall that was better, and that tends to give a less volatile, more consistent review of the employment situation in the US. So generally positive data, and as always with the initial jobless claims, that was at 130, and you can see the reaction after that data. Seemed choppy at the time, but we did actually start that push higher and then move higher, which was also helped by oil. So let's have a look at oil and what happened. I'm speaking personally here, as I got involved in oil on that data, only to get my fingers burnt initially. Here I'm looking at a 5-minute. I'll just change that to 15 so we can take into account yesterday's move. Initially, oil started off, it looks like a very tame move now, but started off by coming off. It was moving lower before the ExxonMobil results came out. Then we had disappointing results from Exxon, which you would think might in fact cause the oil price to move down. But of course, as with oil, and as quite often happens, there can be a rat in the kitchen, and the move had already happened. Then at 1:30 we had the genuinely positive data coming out of the US economy on the employment front, as well as rumours of a gas pipe leak coming out of Canada, or an oil pipe leak I should say, coming out of Canada. This really put a rocket up the commodity contract, and we moved all the way from below 77, around 77, 76, 75, sorry, $2 to above 78.65. So it was a huge move. This chart perhaps doesn't quite do it justice, as I've had to zoom out just so you can see that move. But initial move lower, strong move lower, and then it was the push higher in the oil price that really, as I was saying in the room at the time, opened the door up to moves higher in the US stock indices as well. Just something that I've noticed, guys, looking at government debt. I've got the Bund chart here, looking over the last 4 days, and can you see the clear trend that we're seeing in government debt at the moment, looking at the Bund chart? That's something of a concern, I think. I mean, we're still in the sideways range that I pointed out in the US stock markets, but certainly the trend here in government debt is clear, and that is not a positive sign for risk appetite, not at all. And actually that's the German government Bund. Let's have a look at the US 10-year. It's very similar pattern seen, and actually a spike this morning. I don't know if any of you guys heard, but Fed's Bullard's been on the wires. Actually, he's still on the wires. He won't stop talking, saying that further purchase of government debt will happen if necessary. Further quantitative easing measures are available. Government debt moving higher, stocks still really in their sideways range, a tick lower yesterday. One of the points yesterday also to mention, we had a trend support line again coming up with 11,045 is our target for today for Andreas Long at 1088. But yesterday this was our support level, and as often as happened actually the day before, although generally it has been choppy, that's understandable, but we approached it once and it did work well for the support level then, but then when you get a second test and a third test of such important levels, you can have these pushes lower, and that has been a consistent pattern when we've had these choppy markets. So there was the level of support, it worked, but then when it broke it really went for it, and we were actually quite surprised with the degree to which it broke with. Okay, so let's have a look at this morning. I'll bring up the euro just whilst I talk about it. We've had some negative news on Spain, guys. Moody's threatening again for a downgrade in Spain, and the euro's trading lower as you would expect. They released their unemployment rates earlier this morning. Spanish unemployment has reached a 13-year high of 20.09%. This is not good news for Spain, and you can see the reaction in the euro, and the euro coming round back down to that $1.30 handle in the euro dollar. This price, I've been talking about it all week, not necessarily, on that exact price a clear level in itself, but certainly a kind of magnet that this currency pair keeps on getting drawn to. Bad unemployment levels from Spain. The National Statistics Institute, though, doing the research on this figure, said the number of people actually working increased. So the overall unemployment rate actually rose to its highest level, perhaps because of an increase in the workforce, not just on the headline number that you would assume. So bear in mind what happened there. We've got Chevron earnings coming out, guys, shortly. That'll be the next major figure, 1:30 UK London time. Let's have a look back at the short-term chart, the E-mini S&P, 15 minutes. So I've talked about the highlight today, GDP growth. It's all about growth. The only option, really, although Bullard was talking about quantitative easing this morning, and he still is, the best option for these economies to get out of these doldrums is growth. Really, it's the only option they have. They can't cut interest rates any lower. Certainly if you're talking about European nations, they cannot fund a recovery anymore. In fact, they're at the moment doing the opposite with their austerity measures. And growth is needed in the UK as well. And if you look at Andrea's figure sheet proposal on the US GDP, the range of predictions is huge. You've got 1% to 4% of predictions. Goldman Sachs are the most bearish in their predictions. They're looking for a 2%. JP Morgan 2.8%, Morgan Stanley 3.2%, Credit Suisse 3.1%. So a lot of them towards the high of that range, 3.2, 3.1. Goldman Sachs are the only bearish figure, so I'd keep an eye out for that. But there was some momentum to yesterday's losses, and there's been some momentum on the government debt side. The market's very nervous. This is a very important figure. It's more exciting than usual as well, because the benchmark revision of this figure will in fact stretch back to the pre-crisis era, a time where Americans would see a disappointing day if they hadn't been shopping 3 times and mortgages were given out to ninjas nationwide. Ninjas, I mean no income, no jobs or no assets. This is going to be the first reading of Q2, guys, and as you know with GDP figures, there's 3 readings all in all, so we'll expect the final reading in 4 weeks' time. We'll also get a final confirmation of the Q1 figure, and a revision of that is very unlikely. What I think this GDP figure is likely to show is that there's, the recovery is continuing, but the momentum of the recovery is slowing. I think it will also show that the risk of a double dip remains remote, and perhaps, unfortunately for us guys who are going to be trading in Europe, Piers of course is on holiday, a couple of the other lads in August. August is going to be a slow month, I believe, because if it's still going to be this continuation of the recovery but with a low momentum, I can see this kind of pattern continuing for a few weeks' time, unfortunately, perhaps until September. So it might mean a bit of lack of direction unless this figure surprises to the upside, but certainly I think the risk of double dip has been reduced. One thing to look out for, guys, with these GDP figures is the consumer spending arm of the figure. When these figures get released, as you know, we'll have